Welcome to Cash Flow and Tell, the podcast that uncovers answers to your toughest questions about growing your business from a working capital perspective. Hosted by the people of FundThrough, we dive into real stories and lessons from CEOs, finance pros, and business owners just like you. Today, we're covering when it makes sense to hire a CFO. Now, here's your host, Helen Shacklett, Senior Growth Manager at FundThrough, joined by today's guests, Steven Uster and Deepak Ramachandran, serial entrepreneurs and FundThrough co-founders.
All right, so to explore our topic today, I'd like to introduce our esteemed guest. This is Steven Uster and Deepak Ramachandran. They're the co-founders of FundThrough and entrepreneurs with a whole wealth of knowledge that they'd like to share. So Steven, Deepak, tell us a little bit about yourselves and your journeys as entrepreneurs. Let's start with you, Steven.
Sure, thanks. I'm happy to be here. My journey as an entrepreneur really started after I realized I didn't want to be a Wall Street investment banker for the rest of my life. So I learned a lot of skills right out of undergrad by working on Wall Street as an investment banker, and then took those skills to start a company with Deepak as my partner. And have run several companies before FundThrough, and now we've been doing FundThrough for about 11 years.
Awesome. Deepak?
Yeah, I have a similar story to Steven. I was, I guess, in my late 20s, early 30s when I also had a kind of corporate job. I was at a consulting firm, McKinsey, and I was talking to people about what their lives are like, people who are significantly older than me, what they liked about their lives, what they didn't. And I found the people whose lives resonated the best with me were entrepreneurs who ran their own businesses. So that's what I set out to do back then. That's many years ago, as you can see from my hair. And so this is, I guess, my third or fourth business also. So, and Steven and I started this, as you know, 10 years ago. It's been doing great. And we love helping small businesses to grow and to, find their way. It's not an easy thing running a business, and it's a whole person thing. It takes all of you, not just your work hours. There are no, so it's it's fun, exciting, consuming, and
It sounds like you really caught the bug early and it just went from there. All right, so let's set the stage a little bit. So Steven, I'd love for you to talk to us a little bit about how the finance function evolves within a growing company and the different types of CFOs that are possible.
Sure, yes. When you're starting out, you're unlikely to have a CFO at the table. You're probably unlikely to have any finance person at the table. It really tends to either be the founder if they have some background to be able to manage the books and send out invoices and reconcile payments and file taxes, or it may be a bookkeeper, or it may be sort of an outside, maybe part-time consultant, because really you don't need somebody full-time early on to manage the business. It's probably better to have your scarce dollars spent driving revenue and creating product and selling that product or service. But over time, there does become a need for finance. When you finally do get beyond, maybe the founder or a part-time, and you then progress to maybe a controller or somebody on the accounting side to manage the process until you finally get to a CFO, it's important to note that there are different kinds of CFOs depending on what your needs are and what stage you're at and what's important to you. Deepak and I often think about a CFO as either an external-facing CFO or an internal-facing CFO, and those have different roles and different responsibilities, and therefore a different profile. If you are a business that is looking to raise a lot of money or has some involvement in the capital markets, like FundThrough, for example, where, we have a lot of, debt facilities in place so that we can then provide that capital to small businesses to enable them to grow. That would be you may look for a CFO at that stage who has capital markets experience, or if you're raising equity dollars, similarly, you may need somebody who has an investor focus, not just an internal focus. As well, though, you need to take care of the inside of the shop, and you need to know that what you're doing is profitable. So, what are your real costs, and therefore, what are your real margins, and therefore, what would it take to actually become profitable and maintain profitability? So, there are a lot of different aspects of the CFO role that are important to think about as you are before you even start considering hiring for that role.
As you're getting going, as Steven said, your job as a founder or as a business owner has got to be just focused first on revenue, because that's the thing that is the lifeblood of a business. And that's something usually as the business starter, you have an idea about where you're going to get it. We tend to divide finance functions into 3 buckets when we talk internally. One is essentially bookkeeping and reporting. Another is financial planning and analysis. And then the third piece is the external facing, raising debt or raising equity and getting outside capital. And I tend to think they come in something like that order, So the very first people, I think, Steven, you might have glossed a little over this, the very first people that most business owners need is a bookkeeper. They just get tired of maintaining the books, or the same kind of person who's really good at going out there and winning business is often not the same person who loves to be poring over their QuickBooks at the end of the day and checking to see if their ARs come in and stuff like that. So having that back office person who you can count on, whether it's a part-time role, whether it's for a number of our clients, it's their spouse, or it's a business partner of some sort, but it's often a part-time bookkeeper who can just keep the books and records moving, is a really valuable first ad. And it just takes your anxiety off, make sure your bills are paid, make sure your employees are paid on time. All that basic stuff is usually the very first thing you look for out of finance. We wouldn't consider that a CFO by any means. You really need a CFO, I think, at the stage where you're starting to talk about raising money, whether you're wanting debt or whether you're wanting to raise equity. If you're going for debt, even in the debt world, you don't necessarily need a CFO to deal with, for instance, people like us. We have a lot of clients who come to us directly as the founder and owner of the company. And then some of them have a controller or a head of finance who is not necessarily like a full-on CFO. And then some of them do have people with the CFO title. We can work all that range, but as a business owner, you should know that you don't necessarily need to go that whole hog just because you're raising a little bit of capital. As you figure it out, it'll become clearer, and depending how complex your business is, the sophistication you need will become clearer.
No, that makes sense. It's very contextual is what it sounds like at the end of the day. So what mistakes do CEOs risk by not bringing, it doesn't necessarily have to be a CFO, but a finance leader on at the right time? Basically, what's the cost of inaction, if you will?
Yeah, I think the biggest mistake that CEOs make is thinking about the finance function as a cost center and not as a value adding function. Many entrepreneurs think that keeping your books in order and sending out invoices and reconciling is a thing that has to get done, but nobody really wants to do it, and nobody goes into business to do bookkeeping, to reconcile your bank accounts. But the problem with thinking like that as you are growing is that you might be going in the wrong direction without even knowing it. So you may be, for example, in this hypothetical situation where you sell 3 different products, and you don't know what the real profitability of each of those products is, and you get big orders for the one that is least profitable or not profitable, and you just keep selling more and more and more and wondering why your cash keeps going down, because you don't completely understand, the profitability of each of them and which one you should be focusing on. A good finance leader, and again, this does not need to be a senior CFO type person, will be able to do that analysis. If I even take it a step back, though, it's great to get the PO, or it's great to get the work order, and to get the new customer, and it's great when you do the work, and it's great when you deliver the product. But you're not running a charity. If you don't get paid, there's a gap there with your working capital. And if you're not going to get paid unless you send an invoice. Many entrepreneurs or business owners, because they're so focused on selling and not focused on the back end of the business, won't send that invoice, won't have the time to set up and then therefore send the invoice right when the work is done or the product is delivered. If they had a proper finance person in charge, or a proper bookkeeper at that stage in charge, working on it, they would get paid faster. And getting paid faster is the magical secret sauce of running a business, because you can then use that money to be able to invest in the business, to be able to grow the business. You won't require outside capital, all because you're just simply getting paid for the work that you've already done and the product that you've already delivered. It tends to be something that is overlooked by small business owners.
I would add to that. So the very first finance people that we see people hiring are bookkeepers, because they just need to keep their books. Why though? Usually their first, in that very early times, they're hiring a bookkeeper. If they're not, if they're not familiar with this, they hire a bookkeeper primarily to help with taxes, to move towards their tax filings or their other kinds of filings that they have. And so it goes bookkeeper, then accountant, because they have to file their first taxes. And I'm with Steven. The thing they're missing usually is that they hire a bookkeeper who can keep all the records in good enough shape for the tax person. And often the records are in kind of mediocre shape all through the year until the tax person looks at them and kind of cleans them all up. But rather than worrying about all that, what they really want is a bookkeeper who's friendly and outgoing, which doesn't sound like a normal bookkeeper. And the reason why is that not only does the bookkeeper capable of doing the invoicing for them, if you hire the right bookkeeper and engage them right, they're capable of following up on the invoices, because some customers will pay you promptly when you send an invoice, but many customers will pay you only after you remind them a couple of times. So having somebody who can help with that is often a really valuable function. Same on the AP side, because if you want that cash cycle to work in your favor, a lot of small business owners, when they get a bill, it either goes into a pile and gets forgotten about until they get in trouble, and that can cause all kinds of challenges on the back end of their business because they're not getting what they need to meet their customers' needs, or they get worried about that and they're very tick and tie type people and they just pay the bill as soon as they get it. So I would say when you're hiring that very first bookkeeper, see if you can look for somebody who's not just going to keep your records in good enough shape for your accountant, but actually find somebody who can add value concretely right now by invoicing for you, if possible. When you see the value they're adding is not just, it's not just financial in the sense that they're literally getting the money in and delaying getting the money out as best they can. They're also taking a whole lot of anxiety off of the business owner's mind. Usually that kind of thing is just sitting in the back of your head, making you kind of like, oh God, have I followed that bill? Have I do? But you want to be in the mode where you're just like, okay, what does customer X need? What can I do for customer Y? You know, that's how you want to be thinking, right? So that's where I find that the finance makes the first huge value add. And then, as Steven says, then you get to FP&A, the kind of planning and analysis phase after that, where you're like, oh, wait, which customers are making me money and why and how much and what should I do more of and less of?
And on the FP&A side, it's worth noting that profitability of product line does not only entail, the selling price for that product, less the cost of purchasing that product, for example. What really needs to get included there is all of the resources that you have as a company allocated to each of your products. So how much time are people spending within your company on that particular product, and what is the cost of that? The salaries and anything else that goes into that cost. And then all of these other costs that are associated. How much space does that inventory take up in your warehouse, for example? And does that mean that you have to have a bigger warehouse, and what's the cost? You've got to then think about all of the other costs so you can really understand which product is profitable and where you should focus. And this is called activity-based costings. And this is something that either a really good bookkeeper, or as Deepak says, somebody who has experience with financial planning and analysis, FP&A, can help with. It doesn't need to be a high-powered CFO at this stage.
Yeah, I also find owners themselves often really, they like diving into that stuff.
Oh, for sure. It definitely sounds like it has to be a well-oiled machine there. So I'm kind of curious. So we've talked a little bit about the theory. So was there a moment when you realized in maybe one of your companies, or maybe you've seen this happen in someone else's company, someone you've mentored, when you realized you or they waited too long to bring someone on, a finance leader or a bookkeeper perhaps? And can you tell me what happened?
Well, I could use the example of FundThrough itself. FundThrough itself did not have a CFO for a very long time. We had very capable finance leaders and controllers who were really strong on the internal side of the business. And we had investors who said to us often, "Oh, you should really hire a CFO." We didn't really see what the value was, whatever. Finally, we got to a stage where we said, yeah, okay, I think it is valuable to hire a CFO because we are getting more complicated on our capital markets side. We've grown a lot. We have various different debt facilities. We need to negotiate with banks and other lenders, and there's a lot of complexity associated with that. And then we have equity raises as well. And we said, okay, let's go and hire finally a CFO. And when we did it, our eyes opened up and we're like, wow, if you hire the right CFO, the value that they add is immense. And in our case, the CFO that we hired had amazing contacts and amazing experience in negotiating these very long credit agreements and very long debt facilities that as a layperson or as a business owner, you may not have that in-depth experience. So being able to have somebody on your side of the table to be able to negotiate with large banks and other lenders like that who have somebody on their side of the table is very valuable, because a CFO will the right CFO will understand the key variables and what things you should focus on and what things that are less important. However, there was also a lot of value on the internal side, and Deepak just recently made a comment that wow, I understand when the CFO goes through the audit process with your auditors, or the CFO goes through the financials, and the CFO's job is to always look for what could go wrong, as well as how can I make things more valuable. So they have this tension of both sides. And of course, as an entrepreneur, you're naturally optimistic, right? You always want to look at things going well, and it's nice to have that balance at the C-level, at the leadership table, of somebody who's able to look at everything, analyze everything from both the realistic or the even pessimistic side, to sometimes offset the optimism. And then that balance creates a really strong company.
Yeah, I would reinforce the idea that early on, like when companies if you take our clients, for instance, when have they found real value in getting a finance professional in, and when have they made a mistake by not having them? The early warning signs often have to do around payroll, taxes. So we have a number of clients over the years who've done payroll themselves, or have tried to split the payroll where they pay their employees just the net pay, and then they themselves withhold and pay the government, all the withholdings, all the personal income tax and Social Security and all those kinds of withholdings separately. And we've seen a lot of companies get in trouble with that, because again, these entrepreneurs are busy out on the road or out in the field winning business, and then they forget to pay the government piece, or they drag it out a little bit, or they panic around the payroll. So if payroll is a source of stress in your life, that's a very good indicator that you could use somebody to be managing your back office. And we strongly recommend you go to a full-on payroll provider. Yes, you'll have to give them the cash up front. You can't sort of hang on to that cash for an extra 15 days, but the side effect would be much lower chance of getting in very hot water legally, because that's a very big deal when you withhold money from when you fail to pass on money on behalf of employees. In a similar way, the ARAP, if you're finding that you're having trouble collecting, your customers are kind of inconsistent in paying you, or you need to chase them, if you find that you're paying your bills, you're having to negotiate with suppliers a lot, these are other really good reasons to have a finance person around, before you get to the stage where you're dealing with, debt covenants and facilities and stuff like that. Those would be usually, I'd say, for our clients, those are often the big indicators. And if you've got a good, well-meaning finance person, you can get a lot of creative ideas out of it and really grow your business. That's when people often come to us, actually, when they're talking to they bring someone in finance, and that person realizes, oh, you know what, if we just fixed our working capital cycle, we'd be able to grow much faster. We'd be able to take on that contract that you actually turned down last quarter. That kind of creativity really helps our clients succeed.
Absolutely. No, so much rich information there. So taking us to making some decisions about that key hire. You talked a little bit about how to determine the level of seniority of the finance hire, but I'd love to know, how would you decide whether to bring someone on fractional or full-time? And this is more specific to the CFO role.
Right. I think it's hard to have a fractional CFO. I think it's easy to have a fractional finance leader, somebody, either whether it's a bookkeeper or even, further up, bookkeeper plus FP&A, financial planning and analysis. In my opinion, a CFO is a role that is almost the right hand, that voice of reason sometimes for the optimistic CEO or founder. And it's hard to do that part-time. That person needs to really understand the intricacies of the business and really understand where the business is going and the opportunities and the challenges of that business. And they have to really understand the personality of the other leaders, the people that they're going to be working with. I think that's hard to do as a fractional role.
Yeah, I actually think it's a bit of a U-curve. So, so there are these people called fractional CFOs out there, and it's not an uncommon offering. And I don't think they're offering the same thing Steven's thinking of as the full-on CFO. They tend to be offering essentially one level more sophisticated finance experience than you as a company either realize you need or are used to. And so in our experience, we have been involved. I've personally worked with several where we even brought some in to some of our clients who were having some challenges. And in where they were really useful was in a temporary, meaning not just that they're fractional, but that they're actually for a fixed period, in a turnaround, in a restructuring your chart of accounts, in a fixing your books and records so that we can get you back on the right path. We found that people who have that fractional CFO title can be quite useful. It might be that they're working for you full-time for 6 months. It might be that they're working for you with your team part-time for a couple of years. But they're usually bringing they understand the finance practices, especially, let's say, that are required for a lender, or that are required for God forbid, a restructuring process or something like that. They understand that well, and they bring that sophistication to the table, either temporarily on a full-time basis or temporarily on a part-time basis. So that's a pretty, I would say, rare thing. Where you see a lot of fractional help is at the very beginning. Bookkeepers can often be very fractional, can often have multiple clients. As soon as you move past the bookkeeper and you're talking about somebody who's doing any of this FP&A stuff, I find it's rare like that's when Steven's point is there. As soon as they're starting to do analyses and help you forecast and all that stuff, by then you've got so much other stuff going on that there's a pretty high probability that at least a chunk of your team is full-time,
Deepak, I think that you're reading my mind today, because that is the perfect segue into our next question here. So I would love for you to share a story of when hiring or not hiring a senior finance person changed the trajectory of a company.
As I said, a very classic profile for a client of ours is an entrepreneur who's a go-getter, who's out in the world winning business, and who has a strong, deep grasp of what it takes to fulfill the business and service it, but may not love all the details of the back office and keeping everyone scheduling and the payroll and ARAP and these kinds of things. So given that profile, it's not surprising that we sometimes come across clients who are growing their business really well and have a mess back home, back in the home office. And we don't encourage that for obvious reasons, because it can really bite you. But if it happens, we can help you work your way through it. And one of the ways we help, obviously, is we provide some capital that relieves some of that stress. And then the second is that we have at different times brought people in. And so we have had companies that have essentially found themselves in a position where they were much more leveraged. They had much more risk in their business than they recognized. And that would be the typical thing that you find out when you haven't hired a good enough finance professional. And you've tolerated, for instance, a bookkeeper when you needed a controller, or a controller when you needed a CFO. And a good example of that, we've had more than one business that has started off by saying, oh, I'm going to provide terms to my customers. They can pay me in 30 days or 60 days or 90 days. They don't realize that 60 days or 90 days is meaningfully different than 30 days. The longer they're going out there, the more they're taking, the more there's risk that something's going to go wrong, and there's a big pile. Now, if customer A, who used to owe you 2 weeks or 30 days invoices at any given time, stops paying, you're out a month's income from customer A. But if customer B, who used to pay you, who's now paying you in 90 days, stops paying because they're having trouble with their business, now you have 3 months of income for customer B. And 3 months of income is often a lot, especially if you take that revenue and now you're talking about profit. So I find that that's a simple example of a risk that companies take on without realizing it. That other one I mentioned, where they try to pay the employees directly and pay the payroll remittances to the government separately on their own timing, but almost not always, but very, very often that turns into a major mess. And the owner of the company is personally liable. And there's no way out of that personal liability. You can't escape it. It's a serious personal issue. There's the same with sales tax to a lesser degree. So these kinds of risk. And then we've even had clients who've started lending money to their customers above and beyond giving them free services. And one of our most famous kind of challenges was when we discovered that one of our customers was lending money to their customers, and that definitely got them into a lot of trouble. So I would say the more sophisticated you're doing something, and the more that there's time or uncertainty in any of the things you do, as an entrepreneur, you may not see it, but if that little nagging voice is going in the back of your head going, wait a second, there's a little more riskier than I'm willing to admit. Even if you just have that moment in the shower as you're waking up or going to bed one day when you realize that it's probably a good time to get a second pair of eyes and get that complementary set of skills that Steven and I were describing a little earlier.
Coming from a family of small business owners and a CPA dad, that just gives me anxiety, even all that stuff that people do. That is wild, but very educational. So just getting down to the brass tacks of actually making the hire, I would love to hear both your perspectives on what to look for in the interview, and also some red flags to be aware of and to avoid.
Yeah, great question. So if this person, for example, had a lot of expertise in restructuring and working with struggling businesses, but your business is a growing business and performing very well, that may not be the best fit, because the CFO may, or the candidate may look for ways to prevent risk rather than optimizing for growth. And the same is true for the other side. So if it actually maybe is even more true for the other side, where if somebody has a history of working with growing companies, but your company is struggling a little bit, and you need somebody to really take the reins, that may not be the right person. You need to make sure that you have an open communication and a positive rapport with that person. It's really important that you don't hire somebody who's afraid to tell you the truth, especially in this role. They need to be able to see that distance, like I had said earlier, and be able to share that with you, even if it's an uncomfortable conversation, because knowledge is power. And the more you know, the sooner you know, the more chance you have to make decisions that can impact positively the business. I'm sure there are a lot of other things as well, within the hiring. Deepak, you might have some specific ideas.
No, I think you've hit the most important thing, which is that you can have an open conversation with this person. If you can do that, and that they're bringing something to the table that you don't already have, although if they are just capable of doing a bunch of work, if you happen to be good at finance and you just want it off your plate, that's also obviously reasonable. But that you can have an open conversation is critical. I'd say it's not critical that they've been in your exact industry, but it is extremely useful if they've been in an industry that's by and large similar. So I tend to divide the world into kind of, like there's manufacturing industries that are basically, that's one category, although even in manufacturing, there's continuous flow versus discrete manufacturing. Those tend to have slightly different stuff, and that can make a difference in the finance, believe it or not. Service businesses, there's higher margin, lower volume service businesses like consulting, and then there's very high volume, lower margin businesses like staffing. They again will have quite different dynamics. The way we always interview senior people is we ask them to tell us about our business and what do they want to know. Ask us about our business. What do they need to know about it to tell if it's a good fit for them, especially in a role like a CFO. And so if the CFO is asking you questions that seem insightful and that really, or the potential candidate for controller, it doesn't have to be CFO, any of these roles, is asking you insightful questions that really cause you to think about things in an interesting way and that, seem relevant and related to your business, that's a great sign. If they're asking you questions that seem opaque, you should just make sure you get a sense from them later about why did they ask that question, what were they trying to get to, and see if you can turn that.
I will add one point which is really important. You really can't just outsource the entire thing to them and not know what's going on. We've faced a couple of clients who had their CFO make really big decisions for the company, and they had no idea. As the owner of the company, at the end of the day, you are the owner of the company. It is your company. And there's a balance between, you don't want to micromanage, you're hiring these people because they have skills and, experience, and, you want them to do that. But you need to taste the soup. You need to know what's going on. So at least I'm either informed or I'm finally making the final decision. But it's important to realize that just by hiring a senior finance person, that you can't wipe your hands and say, okay, it's all good. You're responsible still. Your name is on the proverbial door, and certainly on the tax return.
Yeah, that alignment is so critical. So I have one more meaty question, and then I have a few lightning round questions that are frequently asked on the internet, and then we'll wrap it up. So what is the hardest finance mistake that you have had to fix, or you've seen a peer CEO or entrepreneur have to fix without having that finance leadership in place?
Not knowing the cash position of the business until it was too late for whatever reason, whether they were growing too fast or, they were, effectively borrowing from the government by not paying their proper remittances. Whatever the reason is, not having a grasp of the cash position today, tomorrow, next month, and next quarter, and even next year. We've seen it too many times, and it's definitely avoidable.
All right, so here's kind of our lightning round of FAQs. So let's get into it. So should I hire a CFO before or after my next fundraising round?
Oh, well, it depends on the size and stage of the company. That's the truth on this one. If you're raising $100 million, I would say you should have a CFO beforehand. But if you're raising $1 million, you might not need a CFO at that stage.
Fair enough. So do VCs or banks require startups at Series A to have a CFO?
Absolutely not. Actually, I think that they would probably look negatively if the money was spent on an expensive CFO at that stage.
No, definitely makes sense. And finally, so will I hurt my chances of raising if I don't have a finance leader in place?
I would say it would probably hurt your chances of raising if you didn't have somebody who is able to do proper analysis through the diligence process for that investor. And it could be the owner, the founder. It's probably not. It's probably somebody else. It doesn't have to be a senior person per se. It just has to be a really bright analytical person.
Right. It's just the task that needs to be done.
Yep.
All right. So that's mostly it. I would love to hear for both of you, if you had to give 3 takeaways that you want the CEOs and business owners out there to take away from this conversation and what they should remember when making that key senior finance hire, what would those be for you?
Okay. Well, one would be think of that senior finance hire as a way of adding value, not just as a cost center. The second is cash is key, and this person needs to manage and forecast cash. Cash is the thing the engine of the business. And 3. If you don't feel like you have a personal camaraderie with that person, it's probably not the right person, because as I said earlier, you need somebody who you can have uncomfortable conversations with and they feel comfortable telling truth to power.
Yeah, those are good. And so mine may not be top 3, but I would add in that as if you're the kind of CEO who is, or founder or owner who's good at getting business, don't underestimate the complementary value. This kind of goes with the third point Steven said, the complementary value of having somebody who can keep the home front stable and can keep it running. That's a huge value. And that's what I would look for in these finance people. And then just think about that 3 steps I mentioned. So you start with simple reporting and taxes. You move to financial planning and analysis, the kind of stuff Steven's talking about, analyzing and figuring out which customers, which offerings, which products, services are making money and which aren't, and how do I deal with that, cash flow, etc. And then you move to fundraising and external financial relationships. That would be the order in which I think of it, and that tends to be bookkeeper, controller, CFO, roughly.
Well, thank you, Steven and Deepak. This was such a rich educational discussion. I know our listeners are going to love it. Let's go over a few key takeaways for you to apply. First, the senior finance hire is a value add, not a cost center. If you're often out winning business, don't underestimate the complementary value of a professional who will keep the home front stable. Second, cash is key. It's the engine of the business. Your CFO or other senior finance hire needs to manage and forecast cash really well. Third, the evolution of finance framework gives you a rough rule of thumb for which hires to make. When you're starting out, a bookkeeper can manage your reporting and taxes. A controller can help when you're ready for financial planning and analysis tasks like figuring out product profitability. A CFO is equipped to help you negotiate with banks and raise funds. And finally, if you don't feel personal camaraderie with your finance hire, it's not the right fit. Your CFO needs to tell you the truth, even if it's difficult. Knowing what's happening financially empowers you to make the best decisions for your business.
Thanks for listening to Cash Flow and Tell. From all of us at FundThrough, we hope this episode got you one step closer to growing the business of your dreams. Make sure to hit that subscribe button. We'll see you next time.